Travis specializes in the agricultural industry. He provides tax compliance for businesses and individuals, tax planning strategies, financial statement preparation, farm service agency assistance, and farm transition and succession planning. When you work with Travis, you get a tax partner who will work with you. He wants to understand your business and will create a custom approach to help meet your goals. Having grown up on the family farm, Travis understands the financial and operational characteristics of the agricultural industry. And with that being said, I'm going to get our time turned over to Travis.
All right, thanks, Amanda, and good morning, everyone. This marks our final installment of our three-part series on keeping the family farming. Today's topic is obviously on transition planning. As Amanda said, I'm Travis, and I am a partner in our Fargo office. Most of my focus is in that ag industry, whether it's working from an income tax standpoint, tax planning, or transition planning. So as we look at transition planning for the agricultural family, you know, it's a process that's never easy to get started. Sometimes we don't know when to get started or how to get started. As we start, we really got to look at, as we go through the presentation, I'll refer a lot to mom and dad, and I mean generation 1 for that, and the kids generation 2. As we start the process, everybody needs to have a good attitude coming into this. It's never easy to start, so having that attitude is definitely a benefit. When we start the process, we really need to know who the players are. Are we looking at just mom and dad, or there may be 2 brothers that have been farming together that are looking at transitioning over to their children? So depending on how many family members we're talking about, the complexity of each case really changes. As we start to go through the plan, really the way we start out is really just formulating ideas. Where are we at right now? What's kind of the goal and how do we get there? So as we kind of look at those plans, it might take anywhere from 2 years all the way up to 5 years, sometimes longer than that. Every once in a while, I mean, we try and work things out shorter, but if you are looking at transitioning, make sure you're giving yourself time. It is something that takes time. It's never easy to start, but we do need time in there because especially from an income tax perspective, the more time we can have in a clear plan, typically the better the outcome. The bottom bullet point is especially important. No one size fits all. We all know someone that's probably went through the planning process, someone that's retired. The plan that might work for you probably isn't what worked for the neighbor, or vice versa. So every situation we're looking at, it's probably going to be different. So we really need to tailor that plan to each family. So as we kind of look at some of the issues, Mike touched on this a little bit on the first session, but what's the size of the farm that we're dealing with? Can it really support the family that's coming into it, and how many families are coming into it? So when we look at that, what's the size of the farm and what's the size of the estate that we're dealing with? As far as roadblocks that we're typically looking at, it's a gamut of things, but the main ones are the emotional roadblock, financial, and then we get to the income tax piece of it. You know, from an emotional standpoint, a lot of farms that we're working with now, these individuals have been farming their whole life. So it might be 40, 50 years. And you know, at times they might think that when it's ready for me to retire, it's going to be a pretty easy transition and smooth. But when it actually comes time to do it and maybe put the pencil to the paper and figure out a plan, it becomes a lot harder than maybe what that individual had originally thought. You know, from that emotional standpoint too, and the players that are coming into this, we need to make sure that we're obviously communicating with them and giving them the chance to, make decisions before they're kind of handed the keys, so to speak. So making sure that as we're going through this process, they can make decisions. Everyone is different. Some individuals coming to this are more so born leaders and can make those decisions. Other times it's harder and it takes more time. So that coaching process becomes, very important as well when we look at this. A financial piece, we'll get a little bit more into this as well, but can retirement be supported with where we're at from a financial standpoint, and can we make it work with the generation that's coming into the operation as well? Another key one that seems to be a big hang up, and rightfully so, is income tax. For many guys, we've seen, with every farmer, it's very typical, obviously, for inventory to be deferred, and we're doing prepays. So when it comes time to retire, we have, a bunch of grain that needs to be sold in that final year where you don't have prepays because we don't have the expense for the next year. So income tax becomes a key driver into how do we put this plan together. If you're leveraged, obviously we'll talk about this a little bit as well, but you're going to pay tax coming out of this. So you got to have the right mindset coming into it that I am going to have to pay some income tax. There's no way I can necessarily get around it. Can we defer it? Can we make it as efficient as possible? Yes, we can. But make sure you have the right mindset. If you, from that perspective, if you really look at, a farm that maybe they have $1 million of operating debt that they're carrying over, in order to get that operating debt paid off, that's, deductions we've taken in prior years. So we might need $1.5 million or $1.6 million of grain sales in order to get that bank debt paid off. So as you look at that, there's obviously income tax considerations that come into that. Cash flow needs. So this is, one of the areas we typically start at when we're looking at putting a plan together is, what are the cash flow needs for mom and dad as they enter retirement? A lot of times I will ask, how much do you need to live on for a year? And a lot of times I get an answer that is, I don't know. I haven't really thought about it. So, I mean, it is important because I really like to, if we're looking at a 2-year plan or a 5-year plan, cash running formulas and I guess laying out a cash flow plan that works. Where are we at right now? What needs to be sold? What needs to be paid off? What are my income tax consequences? What are left over at the end of the day? Those answers to that really dictate, some of the planning things that we can do from an income tax perspective as we're looking at this, if there is excess cash flow. And then after we get through that, kind of pre-transition phase, where everything has been transitioned over, what does retirement look like from, cash flow coming in from either maybe machinery sales, land rent, Social Security? Do we have IRAs, that type of stuff? And can that generation be supported with what they have? And then the final piece is obviously making sure owner objectives are met. And this really goes, both ways, but sometimes we get bogged down too much in the details while we're working through the plan. So a lot of times what I like to do is start with, what do we want that final goal to be? What do we want this plan to look like once everything has been accomplished? And from there, we can start kind of filling in the holes along the way in order to make that work. So it seems like sometimes we will start and like I say, we get bogged down in the details and get off track. So a lot of times it's the easiest if we can start with, what's that end goal look like? And it might not just be for, that first generation. It needs to obviously be for the second generation as well. So today we're going to be looking at a couple different strategies and things that we would typically look at from a sole proprietor. So that would be if you're currently farming on a Schedule F, and then general partnership, corporations, and then family limited partnerships. So before we get to that, just a couple more slides. So obviously Ava presented yesterday on estate planning. Estate planning, as we're going through this transition, is obviously something that's in the back of our mind. And a lot of times we do want to tie the estate planning piece into our transition planning piece. So, everyone's different. Some individuals are really good at keeping their wills up to date. Maybe things haven't changed. But typically, as you go through this transition, there is a major change in life, and we do want to get those wills updated. And it's also a good time for that second generation to have their wills updated as well. There's many times as we're looking at this, that second generation has already accumulated a decent amount of wealth. So as we look at this, it's really nice to be able to tie the estate piece of it together as well. And listening to Ava yesterday, there's obviously so many options when it comes to that, and different things you can do. And it really does become overwhelming at some point, just with the options. So make sure you have a professional in your corner that really can help you work through that. Big piece to the estate planning and things that we see that sometimes aren't always communicated is making sure that your wishes are communicated to family members. Don't just assume they know. I always refer this back to the combine driver and the grain cart driver. The combine driver always thinks the grain cart driver knows exactly where he's supposed to be, when he's supposed to be there. And that's not always the case. So just like communication is key within your operation to keep running things smoothly, the same thing needs to be said about estate planning and transition planning. Is we need to communicate, and we need to kind of stick to that plan to keep things moving forward. Ava talked a little bit about this too, but how do we deal with farming and non-farming children? So obviously every situation's different, and I don't want to spend a lot of time on this because Ava did talk about it. But typically what I'm looking at is how can we break up farm assets versus the non-farm assets. Obviously the children that are farming are going to need those farm assets, but they might not need necessarily excess cash or a vacation house or IRAs or 401ks, that type of stuff. So typically, if we're looking at trying to even out, I guess, the estate and what's going to each child, we would be looking at those non-farm assets going to the non-farm children, and then farm assets to the farm children. And sometimes it doesn't always work out. We've talked about the fair versus equal, and that's always easier said than done. But maybe there is life insurance that needs to come into play in order to kind of help even things out as well. All right, so financial wellness. So this piece, really comes into play as we're looking at the transition from not only an estate perspective, but an income tax perspective is really what's driving this. So as we look at that kind of scorecard, what does our balance sheet look like, right now? Obviously, bank debt plays a key role in some of the strategies that we can potentially use as we're looking at this transition plan. So if it comes to, it could be machinery or deferring crops. Do we need to sell land to that second generation in order to make retirement work? If we're, looking at land, is there any high basis land that we could potentially sell to generate cash, but not necessarily cause an income tax consequence from that? We have looked at that in several cases. A lot of states do have, good loans for beginning farmers, and with low interest rates now, we have capitalized on some of that with that second generation being able to come in and maybe buy higher basis land from mom and dad in order to alleviate debt. So as we're kind of looking at that bank debt, it really does drive some of the strategies from a income tax standpoint, just because we know at the end of the day, the bank needs to get paid, and then we also have the IRS sitting there. So kind of my beginning example of, someone that's maybe highly leveraged, and this might not always be the case, but if you do have the guy that has that $1 million of operating that's been carrying over year after year, like I said, in order to get that paid off, we're probably going to need $1.6 million of grain sales in order to get that debt taken care of. So if you think about the tax consequences on $1.6 million, we pay her $500,000-$600,000 in income tax on that, pay the bank back, and now there's nothing left. So all of that cash that we've used to generate those sales are already basically spoken for. So now our strategies to kind of minimize income tax might be thrown out the window. So definitely an important piece as we kind of work through this and looking at that beginning balance sheet. All right, so from a Schedule F perspective, so we'll start here with the sole proprietor. We still have many individuals that are farming on a Schedule F, and typically if we are on a Schedule F, our children that are coming into the operation, they're probably farming on a Schedule F as well. So typically, the way we start with this process is that first generation just starts to give up acres, and that would start getting moved over to that second generation. As acres get reduced, our carryover grain starts to dwindle away. Our prepaids start to get less. We're probably going to have some income tax consequences as we do this, but how do we alleviate some of that by playing the rate game and liquidating some of that from an efficient manner? So we'll talk about a couple of those strategies as well. One thing we do typically like to look at is if there is a decent land mass or land from that first generation. Typically, we'd look at them renting that land to the second generation, and then have the first generation still continue to farm some of that third party land. And what that does is it still gives us the deduction, obviously, on Schedule F for our rented acres, but as we get our income and cash flow from the land that we own, we're not paying the self-employment tax on that. So there's typically some benefits to doing that if we're not already maxing out that self-employment tax. And then obviously, anytime we're dealing with any of this succession planning, in any case, really, FSA comes into play in crop insurance. So, depending on the size of the operation, we need to be mindful of limitations with FSA. Are we maxing out limits where we're at right now? What's kind of the sweet spot for acreage with that? Depending on the size of the estate and income that's coming through, are we going to be bumping up against our $900,000 FSA limitation for the first generation if they are going to continue to farm for a few more years? And then from a crop insurance expected consideration, I guess, make sure you're talking to your agent and verifying that your APHs are transferring over to that second generation. In a lot of areas, that's obviously important, and we need to minimize risk as much as we can. So as we're looking at transitioning over acres from that first generation to the second generation, anytime there's opportunity for machinery needs, items like that, we are really looking at how can we move more of this over to that second generation. So if there's equipment that's being traded in, we're probably looking at that second generation paying the boot price and getting some ownership in that machinery. Depending on maybe how long they've been farming, what their financial scorecard, kind of looks like, can they afford to purchase some machinery from that first generation as time goes on? The second piece, looking at gifting of machinery, typically we would look at this if it's maybe, an individual that's coming back to the farm and they don't really have a balance sheet. In order for the bank to give them money, they're probably going to want to see some equity from that individual. We don't always want to have mom and dad have to guarantee those loans that can taint items for FSA as well. So in some cases, we have looked at where we're not afraid of using up some of our estate exclusion on gifting machinery by maybe moving a couple pieces over just from a gift to that second generation in order to bolster their balance sheet. You know, typically when we look at machinery and gifting, if we think there is going to be an estate situation, we don't typically want to use up our exclusion on machinery just because it is a depreciating asset. So if we gift something that's worth $200,000 now, in 10 years it's maybe going to be worth 50,000 or 100,000. So there's no sense on, you know, blowing that 200,000 when it's something that's just going to depreciate. So that's one item to consider. You know, we have had a lot of success with doing equipment leases. And the reason we talk about leases is really this last bullet point here on installment contracts. So you hear a lot of individuals saying, well, I will just go and sell my machinery and we'll do a contract for deed and my son can pay me over, you know, 7 years or 10 years, whatever it might be. Setting that up on an installment contract, what that does is it accelerates all of that income in the first year. So if I had $1 million of machinery that I sold on a contract for deed over 7 years, and just say I got even installments for those 7 years, even though I may be only getting, you know, 100,000, 150,000 in that first year, it actually triggers all of the gain in the first year. Typically basis is probably low in that equipment, so we're going to have a decent amount of gain, and that would all come through in that first year. So that's typically the reason we would shy away from an installment contract. So with that being said, when we look at a lease, the way a lease works is we set that up as just a regular operating lease. And we can do, you know, the full bundle of machinery. Maybe it's a couple different leases where we're looking at different sets of machinery. And a typical scenario with that would be setting up that lease over 7 years with a 30% buyout. So if you take that $1 million of machinery, we would have a 30% buyout on that, so $300,000. So through the first 7 years, we're making payments plus a little bit of interest, whatever that lease payment would be on the difference between the $1 million and the 300. So over those first 7 years, we're going to get, you know, $700,000 plus the kind of an imputed interest rate. And when we structure it as a lease with a buyout like this, we're not accelerating all of that income in the first year. So as you're receiving your lease payments, we're stretching that out and just picking that up as income. So if we can do that and keep the individual in a lower income tax bracket by doing that, it's a success. And also typically from that second generation coming in, making sure that they can cash flow, you know, that piece of the payment as well. When we're looking at the machinery leases too, a lot of times what we're looking at doing then is lumping that in with the land and having everything under one contract. If we do that, then it all just becomes ordinary income. If we have that separate machinery lease, then technically we would be looking at self-employment tax on that. So not only do you have your ordinary income tax you're worrying about, but then you're also paying that 15% self-employment tax. So some of the strategies, so this is from an individual standpoint, obviously. So whether we're farming on a Schedule F, or if we have income coming through from a general partnership or an S Corp, we've probably all heard of farm income averaging, but maybe we don't all understand how it quite works. So when we look at farm income averaging, it is what it sounds like. It's farm income from Schedule Fs or our grain sales less our expenses, our net income, that would qualify. And then also machinery sales qualify for farm income averaging. So when we're looking at averaging, what we're doing is in that current year where we have the income, the amount that we're selecting to average gets layered back over our 3 prior base years. So in that year of retirement, if we do have, a large amount of income that would bump us into a high tax bracket, we can elect to average and take some of that income back over the prior 3 years where maybe we were in a lower rate. So if you look at that, just an example, say the prior 3 years, 2017, 18, 19, we were at 80,000 of taxable income, which puts us right at the top of that 12% bracket. In 2020 now, we're starting to kind of transition over, and maybe we have, $500,000-$600,000 of taxable income. So if we had $600,000 of taxable income, we could essentially take 300,000 of that and average it back and add it on to our 80,000 from our prior 3 years. So we would allocate 100,000 to each year, and we would pay at roughly a 22 and a 24% rate. And then all of our income in 2020 would also be at a 22 and a 24% rate versus maybe a 35 or a 37% rate. So it can be a very powerful tool when you look at being able to take that income back 3 years and average it. And then if we're in a financial position where we can, afford to maybe sell grain out in the next 3-4 years, or look at retirement plans or this charitable remainder trust that we'll talk about, it's possible that we could spread this income out over maybe 6, 7, 8 years when you look at being able to take it back 3 years and then maybe go forward 4 or 5 years. When we look at the timing of grain sales, a lot of times you hear, well, if I retire, I'll just defer my grain and I'll pick up that grain in the next 3 or 4 years. And that'll keep me in a lower tax bracket. And we do always look at that consideration, and I have seen cases where that works. But one thing you got to be mindful of, if we do that, then we're really maxing out that self-employment tax at 15%, for maybe 3 or 4 years if we're picking up $200,000. Whereas if we did everything just in 1 year and did the income averaging, we're maxing that self-employment tax out at the 15.3% up to about $130,000. And then we just have a little bit of Medicare tax on top of that. So you really got to weigh those options as well. Like I say, I've seen some cases where this works, and it really depends on the amount of income that's coming in and what bracket we're in. But a lot of times you are actually better off just taking that income in the year of retirement and then doing our income averagings and saving on some self-employment tax. Retirement plans. So 2 of the main retirement plans that we would typically look at would be a SEP IRA and then the defined benefit plan. So from a SEP perspective, right now, the contribution amount on that is about $57,000, and you would need roughly $250,000 of Schedule F income in order to make that contribution. So all of these retirement plans are a deduction against ordinary income, so it doesn't reduce your self-employment tax, but it is a way to defer, some of these payments out into the future as well. So if you start far enough ahead of time, a SEP can be a great plan where you can tuck away some money and have that for future retirement while maybe deferring taxes from a higher bracket as well. Both of these plans do work the best when we don't have employees, or at least no full-time employees. If we do have full-time employees, typically we're looking at, can we transition those over and maybe have that second generation start to pay the employees, because if we do have full-time employees, then technically they fall under these plans as well. So you might be making some hefty contributions for them too. When you look at a defined benefit plan, this plan really is a SEP on steroids, so to say. With these plans, we usually want at least 5 years. You can make 3 years work, but from an IRS scrutiny standpoint, we'd really like to have 5 years of contributions. And these contributions typically range from anywhere from $225,000 up to $300,000 of contribution per year. So when you think of something like that, if you're in a financial position where we can tuck money into one of these plans, it doesn't have to go back to the bank to pay off debt. We can, push a tremendous amount of grain that's been deferred into one of these plans and push it out into future years. The amount of contributions are all actuarial based. So typically we work with a provider that kind of gives us a range of contributions. They administer the plan. And then the contribution just needs to be made by the due date of the tax return for each year. So these plans typically work very well if you're in a financial position in order to do them. But just like some of these other plans, you got to plan ahead. If you're planning on retiring in 1 or 2 years, that's probably not going to work. We need that 3 to 5 years in order to make it work. Next one, a charitable remainder trust. So Eva touched on this just a little bit yesterday. Typically with these, it's the same deal. We're looking at how can we defer that income out into future years. Same thing, we need to be in a financial position in order to do this. Typically when I'm looking at these, we're looking at putting grain into one of these trusts. The major benefit of this is that income stream gets pushed to future years. We escape the self-employment tax, and we can defer that payment out. So typically when we run these scenarios, it is anywhere from a 5-year payback all the way up to 20 years. Yesterday I had ran for a gentleman just a quick calculation. If we had put $500,000 into one of these plans, so $500,000 of grain, so you're putting bushels in, the trust is the one actually selling that grain. We did a 5-year payback with it more front loaded. And with that in 5 years at a 3% return within that plan, you would end up with about $510,000 of principal coming back. And at the end of the 5 years, a charity would end up with about $75,000. So when you look at these charities, the main goal obviously is there has to be some charitable intent. And what you're looking at is at least 10% of what that original value of assets are. One thing to keep in mind is, when the trust terminates, that's when it passes to the charity. So if that's at the end of the 5 years or at your death. So that's, sometimes the hiccup with some of these plans is, well, what if I don't live to the 5 years or the 10 years? Well, we always have one beneficiary in there. So typically we'll have a spouse in there. But yeah, if something did happen in those first 2 years, then whatever the balance is in that trust, everything would go to charity. So sometimes that can be a hiccup if you're really expecting that cash to maybe transfer over to the next generation, whether it's farming or non-farming children. But certainly another option that we kind of have as a tool in our toolbox to defer out grain. All right, general partnerships. So these typically are one of the more complex items to plan around. The good thing is partnerships are very flexible. Some cases they're more flexible than others. A lot of times when we're dealing with general partnerships, there might be cases where it's just mom and dad, that first generation farming in a partnership. And in those cases, we're probably looking at a different strategy as opposed to if we have, maybe 2 brothers that are farming in the partnership or multiple family members that are farming in this. Maybe we've already brought in part of the second generation at a lesser ownership. So the more members we start to have in here, the maybe more complex that transition plan becomes as well. So it's really kind of identifying our starting point with these partnerships to start with. From a very basic perspective, when we look at, how does the income tax effect work of a partnership if I sell my partnership interest, we typically have a 754 election, and this is from a purchase. So when you look at, if we just use an example of the basis of the individual selling as 0, and they sell their 5% partnership interest for $200,000, we're obviously going to have $200,000 of gain. That's all going to be, for the most part, ordinary income. The person that's buying that interest for the $200,000 is going to get a step up in basis. So we would allocate that over our inventory, prepays, and then our depreciable assets. So the person buying is going to get a deduction. The person selling obviously is going to have taxable income. So that's kind of the I guess, basics of that from a gain perspective. One thing a lot of guys think about too is, can I sell my partnership interest on an installment sale? Typically the answer to that is no, and I'll go over that in a second. One other issue that we see quite often is negative basis. So when we look at negative basis, we think, well, how can my basis be a negative inside of the partnership? And typically what happens there is either I've had losses from prior years that I've, got the benefit of, that's created my basis to go negative. Or maybe I've taken distributions in excess of the income that I've had inside of that operation. So when we look at negative basis, this becomes a whole other gamut that we really got to look at. If you kind of look at that same example of having $200,000 of value, but instead of having 0 basis, if my basis is negative 200,000, well, now I actually have to pay tax on $400,000 of income, even though I'm only receiving $200,000. And the reason for that being is because you are being relieved of debt. That basis became negative because of the financing that we've been doing. And when we're relieved of debt, that triggers income. When you look at that debt in excess of basis, this could be from a partnership perspective or even a Schedule F farmer. If you kind of look at, if we just look at grain sales and say, well, I'm going to get out of my income tax because I got $1.6 million of grain and I got my $1 million of operating, I'll just gift everything to my kids and they can deal with the income tax consequences. It doesn't work in that situation. It doesn't work to gift negative basis in a general partnership as well. If you do end up gifting that, you're still going to have taxable income on the amount of debt that you're being relieved of. So just something to keep in mind. So typical considerations when we kind of start looking at that general partnership are obviously who are our current owners? What do we want it to look like? Who's coming in? Who's going out? Depending on who those owners are, is there ways we can maybe dissect the partnership? If we did just have 2 brothers that were farming in that operation and that partnership was eventually going to go away, maybe one brother's retiring, maybe one isn't. Is it possible to distribute some of that grain equipment, or maybe there's land in there, and start to break that partnership up in order to make it a little bit more manageable for that second generation to come in? As we're breaking it up, then it gives that partner that is retiring a little bit more flexibility on when sales are going to happen from a grain sale perspective, or maybe machinery, land, that type of stuff. So it just makes it a little bit more manageable. If we're working with a very large farm where, maybe there's already multiple members in the partnership, then it becomes a little bit harder to start to dissect that partnership, just because there's too many different avenues where things would need to be distributed. So it makes it, much more complicated and not efficient in order to keep that farm together. The other question we get kind of goes along with the installment sales is, can I do a 1031 for my partnership interest? Unfortunately, the answer for that is no as well. Since we're dealing with, an interest in a partnership, that's not eligible for a tax-free exchange. It would have to be an actual piece of real property in order to do that. When you look at installment sales, this goes back to the same as Schedule F. Why doesn't an installment sale work on a partnership interest? And the reason for that is we still need to look through the partnership and see what is being held. And typically it's inventory, prepays, accounts receivable, and machinery. So all of these items would be considered hot assets by the IRS, and we're not eligible to defer those on an installment basis. All right, so next we'll kind of move on to a C corporation. So we still have quite a few farmers that are farming out of a C corporation, and some of these are corporations that were put in place back in the 70s, 80s, maybe 90s, where we don't see quite as many today, but there are still definitely some out there. So there's certainly benefits when it comes to planning with a C Corp, and there's obviously detriments as well. One thing to keep in mind when we're dealing with a C Corp is we're typically dealing with stock and not the physical assets. The physical assets are still going to stay inside of that C corporation. That's going to continue to exist. So we're really just dealing with stock. So as we kind of look through this, part of it could go back to an S corporation as well. This redemption piece would work similar with a S corporation like it does with a C corporation. But typically, if we're dealing with a C corporation, what we're really looking at is a stock redemption. So when we look at that, it would be that C corporation buying out that first generation. When we do that, we obviously need to get the second generation into the corporation before that first generation can be redeemed out, because we do need an owner in there, obviously. So a lot of times we'll bring that second generation in either by maybe they purchase a share or two for cash, or it could be a gift where a share or two gets gifted. So once they have that small ownership percentage in there, it only maybe needs to be 1%, 2%. Then we would look at doing the redemption. After the redemption takes place, now that 1 or 2% owner becomes the 100% owner. So prior to that, we're really looking at that balance sheet again. What's the value of the grain? What's the value of the equipment? Is there any land in there, buildings? And then what's the debt position? So we kind of would figure out what that net equity number is, and then back out into the redemption proceeds. If we are doing any major gifting, if it gets to be more than, maybe a $15,000 gift, and typically if we are, it's gonna be much more than that, but we would have to look at probably getting some appraisals done for equipment in there, and then doing a business valuation if that gift is large. So one of the major benefits of redeeming a shareholder in a C Corp is this is eligible for installment reporting. So unlike the Schedule F or the general partnership, where we can't use an installment contract to sell, grain and defer it, or equipment, stock, we can use it. So typically what we would see is maybe a note over 10 to 20 years, depending on what cash flow looks like for the buyout of that first generation. And then we do need to charge interest rate. Sometimes it's the AFR rate, which is the lowest rate the IRS would let you charge. Other times we maybe need a little bit more cash flow from mom and dad's perspective. So we'll have interest rate that's maybe comparable to what a local bank would have. So the advantages, obviously, of a redemption in a C Corp is, as we're receiving those payments, the principal piece is getting taxed at a capital gain rate, and then we're just paying ordinary income on our interest that we're receiving. It does give a nice cash flow through retirement for mom and dad, where they have that cash flow each year that's coming from the corporation. As the corporation's making those payments, that interest is deductible inside of the corporation. The other avenue that you could take, but is usually less beneficial, would be as if you had that second generation purchase the stock outside of the corporation. So it would be very similar to you going out and buying, Ford stock or General Motors, whatever it is, you own that outside. This would be the same deal. They own that stock outside as an individual. But the issue with that is, as we make those installment payments, we obviously need to get cash over to that second generation to do that. And a lot of times it ends up having to be a W-2 wage. So now we're paying ordinary income on that plus self-employment tax in order to make that payment. The other downfall is the interest becomes an itemized deduction. So a lot of times if we're not itemizing or we don't have other investment income, that benefit is being lost as well. So typically we would always look at a redemption inside of the company. So disadvantages of the C Corp. So, when we look at mom and dad's side, it's a big benefit that they're getting capital gain treatment on this. The downfall is we don't have a step up in basis on the assets when we're making these payments or when we do the redemption. So like we talked about the example with the general partnership where you get this step up in basis and whatever the seller's reporting for income, the buyer is eventually getting a deduction for. We don't have that option inside of a C corporation. So mom and dad are picking up income. There is no deduction besides the interest on the corporation, so that those principal payments really need to be coming from after-tax income. So how do we kind of combat that? Typically what we're looking at is, as we're valuing that corporation, we do look at what's the deferred income taxes inside of that corporation. And typically we'll set that up as a liability, which obviously reduces the equity. So that second generation is getting somewhat of a benefit by selling at a discount when we're doing that. Last piece is with these redemptions, that first generation, the only thing that they can have in that corporation now is they can still be a landlord. So you could rent land to that corporation, and then you can be a creditor. So your note is in there. But for, I believe it's 10 years, you can no longer be an employee, an officer, director, or get paid for any type of consulting, custom hire, whatever it is. Typically we don't have issues with this. There's usually a way we can work around it, but something to be mindful of. So as we kind of start this process as well, some of these corporations do have a decent amount of cash in them. One thing we would look at is if there is excess cash in there, do we want to keep that in there, or should we be doing a dividend out of the corporation? The reason, this cash has been built up in there is because of the double tax effect of the corporation. Let's go back here. So as that corporation's been, paying tax along the way, they haven't distributed any of their earnings because they don't want to pay that dividend. Well, if you look at some of these older corporations that have been around 20, 30 years, there starts to be a buildup of cash. So, in many cases, we have distributed that out before we're looking at doing the transition and paying that tax and being done with it. So when we look at that, it really goes back to cash flow needs as well. So C Corp liquidation, this would be if you have a C Corp and you don't have an heir that's coming in, we don't have that second generation that's looking at coming in and purchasing that C Corp or doing the redemption with. So in these situations, typically, we are looking at 3 to 5 years minimum in order to do planning to wind this corporation down. When you kind of look at it, being able to sell those assets, pay our tax inside of the corporation, and then also having to distribute that cash, it's not uncommon to see a 45 to 50% tax rate in order to liquidate that corporation. So as we're starting to do that, one thing we're looking at is in some of those final years is, have we been paying fair market value rent? Have we been paying market value for wages? If we haven't been, a lot of times we'll kind of put together a schedule and do a catch up where we start to maybe pay more rent or more wages back to that individual. And it's just one more way we can suck cash out of the corporation with only paying one level of tax on it. And that's really where, these DB plans come into play as well. We've used a couple of these in C corporations, and it works very well just from being able to, stick away that $225,000 to $300,000 a year. That's money we're taking out of the corporation, saving from the double tax, and then deferring down the road as well. So if you are in this situation, you need more time. So make sure that you're talking to your tax preparer ahead of time if you are in a liquidation position. Go to the next slide here. So running a little bit short on time here, but we do have issues where we get land trapped inside of a C corporation. In these situations, typically what we're looking at doing is eventually making an S election. So before we make that S election, though, we do need to liquidate inventory and equipment, and then we would have to pay out all of those profits. So in this case, it would be, paying some double tax on that. But as we make that S election, the reason we need to have all these earnings paid out is if the only thing that's left in our corporation is land, we would run into issues with a passive investment income tax if we made that election to an S Corp. So if we don't dividend everything out, we're going to run into that and eventually blow up our S election. So if we get by that, we have our S corporation that just has land in it. We can't sell any of that land for 5 years. We have to hold on to it for 5 years. Otherwise, we run into a built-in gains tax, which is 21%. So after the 5 years are up, though, in that case, you could sell land and it would just be a capital gain. So your basis would carry over in that land. And you would pay one level of tax at the individual level if you wanted to get that land out of there. So C Corp, S Corp, same deal. We can't distribute land out of a corporation without it coming out at fair market value. So that's different than what we would experience with a partnership where we can freely transfer land out of a partnership. The other piece that could potentially work if we did have one shareholder that was still in the corporation, if they were to pass away, assuming we've got past our 5 years, they pass away, we still have a step up in basis on death, we can get out of this tax free actually. And the way that works is the stock gets a step up in basis. So if we had $1 million of farmland in this corporation, we would get $1 million of basis in our stock. We sell our land. The land itself doesn't get a step up, so we would potentially still have $1 million of gain on the land. But since that basis starts at $1 million, our gain now increases our basis to $2 million. So if we liquidate everything in 1 year, we would end up with $1 million K1 and also $1 million loss from our liquidation. So the two would offset. So in that situation, if we have that step up, we can get out of this with pretty good tax consequence. But obviously something like that takes major planning and time as well. Family limited partnerships. So kind of last piece of it here, Eva touched on this a little bit yesterday as well, but we've really seen a lot of activity in the last 5 years or so with individuals setting up partnerships. They really like it just in order to keep that land mass together. It's definitely a way to get some value over to the non-farming child without necessarily having to give them just a quarter of land or whatever it might be. So it gives that farming child an interest to kind of control that partnership, pay cash rent into it, and at the end of the day, the farming or non-farming child maybe just gets a dividend out of this entity. So definitely a lot of benefits when it comes to setting up these partnerships, not only from a operational standpoint, but also from an estate planning perspective as well. Eva had kind of talked about this too, but if depending on where the estate is do we want these discounts to lower the value of the land? Some cases not. Some cases where we are in an estate situation, then we want that discount in order to be able to reduce the estate and kind of keep that land in the family. Last slide here. Actually, we got a couple left. I won't go through all the steps, but you guys can kind of read through this. The one thing I did want to go through is for those of you not familiar with really how some of these partnership works, if you just haven't been around them, is what's really the logistics of it, or how does it actually work from a operational standpoint. And it really is quite simple. I mean, this partnership would file its own separate tax return. The farm operation pays cash rent into the partnership at market value, whatever is determined, just like you would pay to any third party. Once the partnership collects that rent, they would obviously be responsible for any property taxes, maybe some insurance, and then if there's debt on the land payments. Anything that's left in that checkbook could be distributed out to the owners. So that's all based on ownership. So if maybe mom and dad still own 80% of the entity, maybe you have a farming child that owns 15% and a non-farming child that owns the other 5%, that cash would come out pro rata based on those ownership percentages. And then from an income tax perspective, it's the same thing. Everybody would get a K-1 with their portion of the income on it. So that's essentially the, I guess, nuts and bolts of how those partnerships work. They're typically fairly simple and straightforward once they do get set up. So that kind of concludes the session. One thing I would say, if you are looking at turning things over to that second generation, is make sure you get started on it. A lot of times when we do these presentations, we see individuals that, they get excited about it and they want to move on and start formulating a plan, and then life hits and we get sidetracked and we don't keep up with it. And then all of a sudden, maybe a couple years go by before we get intrigued again. So, make sure you start that process now. It's definitely important. A lot of times when we do get through this, I mean, you will have the weight lifted off your shoulders. This really weighs on a lot of guys, not only from an emotional standpoint, but how do we transition this over? How do I get my estate in a position where I feel comfortable and my kids feel comfortable? Like we've talked about, it's never easy to get started, but I think the benefits of doing it and doing it early, kind of laying everything out on the table, are definitely beneficial for everyone. If you do have any questions, I believe there's a chat feature. Otherwise, I would certainly welcome any phone calls. My direct line is on here. Otherwise, my email. So if you have any certain situations or anything specific you'd like to talk about, please give me a call.